Welcome to a new week, PFXers. The market has been pretty volatile this morning so far. It's, the dollar is gaining against some of the majors. We do have commodity prices being particularly volatile, oil, etc. So that's pushing the commodity currencies around. And you'll notice that the euro and the yen are both retracing largely what the movement that we experienced last week. In fact, oftentimes I look at the Forex as kind of two different markets. It's very interesting. We have the Eastern market and we have the Western market. So it's just a matter of market hours and when are traders coming online and when is news coming out, which really comes out in basically two cycles. So one of the things that I like to do, by the way, and looking at the euro-US dollar right now just as an example of something that's really stuck in this consolidation range, is to try to get a couple of those back and forths between these two markets put together by changing it to a two-day chart. So here's an example, by the way, of the euro-US dollar. It's changed to a two-day chart. And you can sometimes this helps me to see what's the technical pattern at play without getting too long term. I mean, I don't want to look at necessarily a weekly chart. That's getting quite a ways out there in the long term. But a two-day chart is interesting because you get a lot more of that back and forth. What that's saying to me right now is that we have a market with a fair amount of indecision. So why is that? What's going on? Well, for one thing, everyone knows that the Fed, the FOMC, is coming out this week with a new policy announcement. Now, there's been a shift in bias in that we've got, as of the beginning of last week, there was a very high level of certainty that the new interest rate was going to be 2.25%. Well, in light of some of the news we've been seeing and just a stagnant economy, etc., now traders are pulling all the way back. Now there's less than a 50% chance that there's going to be a 25-point rate hike, and most analysts are, quote-unquote, expecting to maintain stability, so at 2%. Well, this is interesting. This gets to actually the topic of conversation today, and that is pre-market volatility. I find that oftentimes, whether you're a Forex trader or an FX options trader, I think this is a very relevant discussion. There are infrequently, but once in a while, periods where we know that lightning is going to strike. So we know on Wednesday the FOMC is going to come out. We've got an announcement due from the ECB. And what do we expect? Well, we don't know. It's really uncertain. But one thing that we can be sure of is that that uncertainty will create amplified risk, which creates amplified volatility. Well, this is important, particularly if you're using options to control risk or even to speculate. So, for example, the beginning of last week, we talked about a strategy where we were looking at the euro-US dollar, which, if you look at my little line drawing here, consolidating in this nice tight range, and we weren't expecting the market to break out anytime soon. Well, at the time, we basically sold a short straddle. So two options, a call and a put, right at the money strike price, which at the time was 54.50, which paid us 379 pips. So it's been a week. The market really hasn't moved very far. It's up and down 50, 75 pips in that range. But every day, what's happening is that the options market is pulling time value out of those options. Now that's good for us because now this particular option has actually, or this particular combination of options has declined in value by 66 pips. In other words, we could buy them back and recognize or keep those 66 pips worth of profits. Well, that's actually what I would do. And here's the reason. What we don't want to do is to ignore the fact that volatility is likely to get a little kooky as we start coming up to these announcements, in particular if something unexpected happens. What if they do raise the interest rate? What if they lower the interest rate? There could be some big moves in the market. Well, here's what happens with that. Not only do just straight spot traders have to be careful about this and provide some hedge in their portfolio, but options traders will find that this particular combo is going to make a little bit of a U-turn in its pricing and start to rise in price. That volatility will inflate the price of those options. Therefore, the potential profits here are going to take a temporary dip, even if the market really didn't move anywhere, or at least stay flat. But we're not going to see a lot of profitability. In other words, between here and Wednesday, the traders are going to start getting more and more anxious. They're going to start hedging. That drives demand for options, which in turn is going to increase volatility. And these options are probably not going to escalate in value between now and then. So oftentimes what you'll find is short straddle traders will be selling the short straddle. They'll buy it back when they can see lightning is going to strike. They wait for that episode to happen or to roll over. They get right back in. So it's this rolling in and out of these particular trades. It's the idea here. And sometimes there are 2 or 3 weeks between the time you enter the trade and the time you want to maybe separate yourself from the market and then get back in. Other times it's very short, so there may be a week where you have the same idea. You may be getting into the exact same trade following that announcement, but what you're trying to avoid is this escalation in volatility, which could ultimately drive down the profits that you've accumulated so far.